Across the Western world, homes have become hard to afford. In Sydney, a typical home now costs about 14 times what a family earns in a year, and Vancouver isn't far behind at around 12. For most of the last 30 years, prices have climbed faster than incomes almost everywhere, and this is the story of why. To begin, we have to discuss origins. The usual explanation as to why the average Joe can't afford a home is to point at someone: landlords, Wall Street foreigners, short-term rentals. But most of that is either wrong or fairly minor, and we'll come back to it. The bigger change is in what a house actually is. For most of history, it was, above all, a place to live. But over the past few decades, it has become a financial asset, something people buy partly because they expect its value to keep climbing. Almost everything that follows comes out of that one paradigm shift. There are four main reasons prices rose, and the first is land. Most of what you pay for a home is the land underneath it, not the building on top. One long-run study of house prices since the Second World War found that land, not construction, accounts for about 80% of the increase. And the reason that matters is simple. You can always build more houses, but you can't make more land where people actually want to live. The second reason is regulation. In a lot of cities, building more homes on a given piece of land is either restricted or banned outright, and economists can actually put a price on those rules. One, they call it the zoning tax, the gap between what a home sells for and what it would cost to simply build. In the San Francisco Bay Area, that gap comes to more than half the price of the house. In Los Angeles, it's over 30%, and in Boston, around 20%. But in cities like Houston, Cincinnati, and Birmingham, it's close to zero. In California, roughly 80% of residential land is set aside for single-family homes and nothing else. These rules really began to tighten around 1970 as a wave of environmental and growth control laws spread. And at almost the same time, the productivity of home building stopped rising, even as factories kept getting better at making nearly everything else, though that particular finding is recent and still debated. Either way, the result was a squeeze on supply, very little new land, and hard limits on building upward. The third reason is cheap money, where after the financial crisis of 2008, and again after 2020, central banks pushed interest rates down close to zero. By January 2021, the average 30-year mortgage in the U.S. had fallen to a record low of 2.65%, and once you adjust for inflation, rates were briefly negative. In effect, the bank was paying you to borrow. When borrowing is that cheap, buyers can afford to bid more. And when safe investments are barely paying anything, investors go looking for assets that are climbing, with housing near the top of the list. So scarce housing met cheap credit, and prices rose quickly. Now for the villains everyone reaches for. Start with the big investors, the Wall Street landlord you keep hearing about. The claim is that they've bought up something like 20% of homes, and that number simply isn't true. Large institutional investors own about 3 to 4% of single-family rentals across the country, and even the biggest firms, the ones holding 1,000 homes or more, own less than 1% of all single-family homes. Nationally, they're a small player, but locally they can matter a great deal more. In Atlanta, in late 2021, investors bought 41% of the homes that sold, and a year later, they were buying up about a third of the cheapest homes in a single quarter. So the effect is real, but it's concentrated in particular places, mostly at the bottom of the market. Then there's Airbnb and short-term rentals in general. The research here is fairly clear. A 1% rise in short-term listings pushes rents up by about 0.18%, and prices by about 0.26%. You can measure it in tourist towns, but nationally, it barely moves the needle. And then there's immigration, which needs more care than the rest. The timing is the tell. In the U.S., prices took off in 2020 and 2021, before the sharp rise in immigration that came in 2022 and 2023. Something else was already doing the work, and it was mostly demographic. There are around 72 million millennials, the largest generation in the country, and they reached their prime home buying years right in the middle of a pandemic, just as credit was at its cheapest. That said, immigration is a genuine factor in some places. In Canada, the population grew 3% in a single year, the fastest since 1957, and one government study put about 21% of the price growth in larger Canadian cities down to immigration. So it adds to demand, especially in Canada and in the rental market, but it isn't the main cause everywhere. What all of these have in common is that they are reacting to the same underlying change. Once a house became an asset that reliably goes up, everyone moved in the same direction: buyers, investors, and anyone with money looking for a return. So, can any of this be reversed? The clearest test we have comes from Auckland, New Zealand. In 2016, the city loosened its zoning across most of its area, so that building more homes became allowed by right in far more places. Over the next 6 years, it issued roughly 43,500 more building permits than it otherwise would have, and rents ended up an estimated 14 to 35% lower than they would have been. The share of income that people spent on rent fell from about 22.7% to 19.4%. Some economists think that effect has been overstated, and the exact size is genuinely disputed, but the direction of it is not. When you let a scarce thing become a little less scarce, its price cools. There is a fourth reason prices have stayed so high, and it is the most recent. In 2022, interest rates climbed sharply, and by late October, the 30-year mortgage rate had reached 8%, the highest in 20 years. Normally, higher rates cool a market down. Instead, from 2021 through 2023, home prices rose about 17% faster than rents, even as mortgage rates went from under 3% to over 6%. The main reason is something called the lock-in effect. Millions of homeowners are holding mortgages below 3%, and since selling would mean taking out a new loan at around 7%, they simply stay put. Researchers estimate that lock-in explains roughly 40% of the gap between where prices should have been and where they actually landed, and that it makes any given home more than 20% less likely to come up for sale. With so few homes on the market, prices held up even as demand cooled. The exact mix, though, changes from country to country. In the US, the story is mostly about underbuilding after 2008, running into restrictive zoning. In the UK, it is largely about the retreat of social housing. Council housing fell from around 6.5 million homes in 1979 to about 2 million by 2017, as roughly 2 million were sold off and never replaced. A British home cost about 3.5 times average earnings in 1997. By 2023, it cost more than 8. Among younger middle earners there, home ownership dropped from 65% in the mid-90s to 27% 2 decades later. In Australia and Canada, tax rules and strong demand added pressures of their own. So there is no single villain here, and no single fix. What ties it together is that a house became a financial asset, and an asset that has been climbing for decades tends to keep climbing, unless the rules that keep it scarce are changed. Auckland, which had upzoned 3/4 of residential land in 2016, produced a construction boom and held rents an estimated 35% below the average, is the proof that they can be. And if you enjoyed today's video, don't forget to like, share, and subscribe. See you all on the next video.